Hello and welcome to the Trading Bell. Glad that you have joined us. And I say it again, Happy New Year. I hope it's not too late to say that. Thank you so much once again for joining us. Now, at the close of last year, we had quite a number of changes, especially on the tax laws, especially on the Tax Laws Amendment Act 2024, the Tax Procedures Act 2024. What does this mean for business, especially the operating environment, and what are the net effects, especially on the economy? We want to discuss that question. I'm joined by two amazing gentlemen. I have Churchill Ogutu in the house, who's an economist at ISEC Group, and Fred Kimodo, Associate Director at Deloitte East Africa. Let's get straight into the conversation. Gentlemen, welcome to the conversation.
Thank you.
Thank you.
Let me start with you, Fred, on my immediate right here. And I want to really ask you to help us understand on a basic level what really motivated this particular changes that we're seeing in the Tax Laws Amendment Act and the Tax Procedures Act 2024.
Thank you, Maina, again for having us, and Happy New Year to our audience as well.
Absolutely.
You will recall that in June 2024, there was a finance bill that was withdrawn just before it was assented to by the president.
Absolutely.
The finance bill 2024 was targeting to raise around 346 billion Kenya shillings. Mm-hmm. So as a result of the withdrawal of the bill, then what it meant is that there was a gap of that particular revenue. There was a revenue shortfall of 346 billion. Yeah. So I guess then, even though there was the conversation of doing some budget cuts as a way of fiscal consolidation, the budget cuts were not seen to be enough. Mm-hmm. There had to be then tax laws that would be introduced for them to try and close that particular gap. Yeah. And that's, I think, the main motivation as to why you saw the Tax Laws Amendment Act being enacted last year. Yeah. And of course, the Tax Procedures Bill and other business laws that were also enacted in terms of just trying to spark growth in the economy. Yeah. So I think the Tax Laws Amendment Bill by itself, I think the figures that you have seen out there, it's aimed at raising around 174 billion Kenya shillings, which then speaks to the reason why they were more or less motivated by the fact that we needed to mobilize some additional revenue. But besides that, you recall that we have a medium-term revenue strategy. It's a policy document that speaks to a number of changes. Yeah. So given that quite a number of changes had already been taken in under the finance bill of 2024, which was withdrawn, I think there was also then the push from the government to ensure that those policy decisions are also taken into account. And as such, we saw quite a number of changes that were in the finance bill of 2024 that had been motivated by the medium-term revenue strategy coming in through the Tax Laws Amendment Bill and the Tax Procedures Amendment Act.
Yeah.
Yes.
I'm sure Kenyans constantly wonder what to expect, but I hope we shall unpack this and see whether we have some wins and some other things to discuss. But Chachi, let me bring you in and ask you, you have the bird's eye view, I keep saying that, of looking at how we're operating here locally and even around Africa. But I want to ask you, how do these laws align with the Kenya's fiscal and economic priorities from your point of view?
Thanks, Maina, and thanks once again for having us. I totally agree with Fred's sentiments around the whole rationale of bringing these two pieces of legislation around the tax revenue mobilization. Yeah. As has been correctly pointed out, basically this came after the shelving off of the finance bill 2024 and where there was a gap that was there. Absolutely. And obviously, once a legislation has gone to parliament, and for one reason or another has been shelved off, as was the case with finance bill, there's usually a 6-month period before that particular bill is being reintroduced. So the finance bill was brought into parliament in May. So that's where you saw in November this particular tax bills being reintroduced in different formats, but basically cherry picking some of the positive aspects of finance bills, quote unquote positive aspects. So that is where we are. But obviously the overarching theme is basically the revenue mobilization efforts, the gap that was there, which was around 347 billion from the finance bill. And here we have close to around 175 billion to be mobilized from these two set of legislations, the tax amendment and also the tax procedures. And then another thing is that if I may take you back to the other previous financial year, the one that ended in June 2024, on the expenditure side, there was close to around 215 billion that was not sort of spending that was not made by the end of the last financial year. And this is because of the revenue and the performance, even despite the supplementary budget that we saw coming in April, we are not able to meet the revenue, and that impacting negatively the spending for the last financial year. So the supplementary budget that was passed in the first in the month of August incorporated 68 billion out of that to 15 billion. So from reading the IMF report, it's like they want now to be able to sort of the unspent spending to be able to be made in the current financial year. So you are at a situation whereby you are increasing spending, but there's no money to be able to fund the spending. So that's pretty much the rationale behind even this tax laws amendment, at least to be able to ensure that the fiscal deficit is still pretty. Fiscal deficit is basically the revenue minus spending. So there's normally a gap in terms of financing. So as a percentage of GDP, needs to be maintained at 4.3%. So basically, that's pretty much the rationale that you're seeing behind these tax laws.
Okay, excellent there. And Fred, let me bring you in. There's a lot of debate that yes, we are bringing these laws, these amendments, and one of the key questions is: are we attracting, foreign investments, or are we pushing them away? I don't know. What are your sentiments when you look at it?
What would be my answer? I think my answer would be yes and no. Why do I say yes? The reason I say yes is because if you look at Tax Laws Amendment Act itself, there are quite a number of changes that are pro-investment. I think key among them, you'll recall some time back, Kenya increased the CGT rate or the capital gains tax rate from 5% to 15%. Now we have seen a move under the Tax Laws Amendment Act where they have lowered the 15% to 5% for investments that are certified by the Nairobi International Financial Center, which is good for investment. We have also seen a move to exempt transfer of businesses, which is also good for investment, for investors. Because remember, prior to this particular amendment, if you are to transfer your business as a going concern, you are required to account for VAT at the rate of 16%, which is very, it's actually against international best practice. And I'm not aware of any of the countries across the region or even across Africa that probably impose that level of taxation. So going back to the exemption then is also a good thing. I think you have also seen some other changes, for example, removal of VAT on raw materials for the textile industry, some specific raw materials, which is also good for the textile industry. So I think those are the things that maybe make me think that it is good for investment. Why do I say no? And I hope I don't count more issues than the yes that we do have. But of course, we also have some, and not specific to the Tax Laws Amendment Act. I think Kenya, though we have a national tax policy, we have seen quite a number of frequent changes, which is not very good for businesses. So sometimes investors are keen to invest in an environment where the tax environment is a bit stable, because you don't want to make decisions today for the tax policies to be reversed, the following year when you have already put in your commitment for investment. So I think the frequent changes that we are seeing in the tax laws are not good for the economy. And of course, quite a number of other things, especially as we try to net more taxes from the digital economy. We have seen the doubling of the what we call the digital service tax rate, although now it has been rebranded to something else. I'm sure we'll get to that conversation. So we have seen doubling of the rate from 1.5% to 3%. We have also seen an effort, or rather, an introduction of a provision that targets taxation of income on that is accrued or derived through a digital marketplace in form of withholding tax. And it is drafted in such a manner that it more or less actually captures non-residents who are actually supplying digital services to Kenya through a platform that is also a non-resident, which is obviously then not very good for business, because if I'm seated, for example, in South Africa and I have an option of selling my goods through a certain platform in the US, and they tell me if I sell to Kenya, I'll do a deduction of 20%, I'm likely to be motivated to tell them sell to any other market but not Kenya. So I think those are some of the things that we probably see that may be against investments. But overall, I think we are headed to the right direction.
So is this what we are now calling the SEP tax replacement?
Yes, exactly. So You recall under the Finance Act of 2020, with effect from 1st of January of 2021, the government of Kenya introduced what we call digital service tax. Digital service tax is actually a tax that is targeted at taxing the digital economy or other businesses that are out there, and they are deriving or accruing income from Kenya. Digitally, they don't have a physical presence. So the rate was 1.5% of the gross turnover or the revenue. So what we have seen now under the Tax Laws Amendment Act is an overhaul of that digital service tax, replaced with what we call significant economic presence tax, or basically SEPT. And there are three fundamental changes that have happened under SEPT, from DST to SEPT. One of them is, of course, the rate, as I did mention. The rate effectively has gone to 3%, and of course also how we are computing the tax. So initially, as I mentioned, for DST it was as a flat rate. It was 1.5% of your revenue. It could go to some other complications. But then the current one is more or less deeming profitability of a non-resident person. So it's deeming profitability of 10%, and then you apply 30% on the 10%. So what that means is that if you are a non-resident person, that is a foreign company, you accrue income or derive income from Kenya through provision of digital services, and you make revenue of 100 million Kenya shillings from Kenya, then we deem that your profit is 10%. So you'll do 10% of the 100 million. So that then we deem that you have a profit of 10 million. Then we apply 30% on the 10 million. That is why I'm saying the effective tax rate then becomes 3%. So those are the main changes that you probably have seen on SEPT. There has been a question as to, and of course we have also seen an introduction of a threshold. I think that's the third change that we have seen. Initially DST didn't have any threshold. Globally, it is good practice to have thresholds also because of compliance. We don't want to spend $100 to pay $50 to the revenue authorities. So that's why you see most of the countries putting thresholds. So Kenya has also put threshold for SEPT. It's currently put at 5 million Kenya shillings. The only issue is that it is not very clear on whether the 5 million is jurisdiction based or it is the global revenue. But based on the reading of the law, it appears like 5 million is the global revenue. Which then would probably mean it may not capture, it may capture very few individuals, because most of the guys that you're trying to target are the ones with very big revenue. The practice is to have a threshold for global revenue and also for jurisdiction revenue. Like if you look at Nigeria, India, they have thresholds that are more or less jurisdictional based. So we have 5 million that is actually derived or accrued from Kenya. There has been a question as to what motivated it. I believe there's more to it than meets the eye, but there could be a question in terms of what is happening globally as far as the inclusive framework is concerned.
But I think we must appreciate it, because we are saying, and just for our viewers to understand this, you, for example, use Facebook. Facebook make revenues when you have to advertise something there. And we are saying when they make that money, all that money goes to them, but we want them to leave something small here. I think that's what they're trying to say, is it?
No, it is for sure. And remember, we have also been all talking about expanding the tax revenue, all of the tax base.
The tax base,
which we need to actually do. But the only concern is how we do it, because we have to do it in such a way that we don't encourage capital flight. But I agree with you 100% that we need to expand the tax net.
Absolutely. Chachi, let me bring you in because from the bird's eye view again, you're looking at what other countries are doing as well in Africa and those kind of things. And I'm sure you have seen these conversations happen. I don't know whether we are the ones pioneering it here in Kenya, but from your own view, could you touch on that conversation on what they are doing internally? But also, we're talking about stability, as Fred has put it, in a way that we do not really chase away the investors. We want them to as well feel this is predictable. Have we gotten to that level where at least you can say the changes are not too crazy, or are we still have a long way to go?
Thanks. As to first, what's happening across the continent, if you look at issues to do with digital taxation, it's gaining currency, and it's part of the OECD and a number of reforms around the digital economy, things such as minimum tax. You find that a number of economies are gradually implementing some of those principles from the OECD. So it's done on a piecemeal basis. Obviously, as you can see, digital economy is quite, it used to be one of those hard to tax, or it wasn't taxed sector, taxable tax sector up until 5-10 years ago. So a number of countries are pretty much following the same route. Getting into the predictability, I mean, that's something that has been concerning to the businesses, more so the frequency of the tax changes. More so in Kenya, that's been quite of the thorny issues. If you sort of do a comparable analysis of even the various tax bills across the East Africa, for instance, you find that the number of tax proposals in Kenya is quite numerous, like say Uganda or even in Tanzania. So that just tells us the way in Kenya that we keep on changing the taxes at an alarming rate, and which is quite concerning even to the businesses. And as Fred had mentioned earlier on, you may find that a change is put in this financial year, the next financial year is reverted back. So it doesn't bring the certainty to the businesses. So that's something that if the authorities could have stuck to the medium-term revenue strategy. And this is a framework that has to be implemented in 2 phases. The first one was from the current financial year all the way to financial year ending in June 2027, and then the second phase all the way to June 2030. And it was clear in terms of the tax proposals that need to be put in place and the financial year that needs to be put in place. If they could have adhered to that, because it's something that is visible to businesses, to everyone, at least that could have removed the layer of uncertainty that is normally there. But what did they do? I think they probably excitement of trying to hone additional revenue, and then they sort of pivoted away from the medium-term revenue strategy. But at least right now, from what you are hearing, the tone from what you are hearing from the current fiscal authorities is that they are slowly reverting back at least to adhere to the medium-term revenue strategy. And that's where you've been hearing proposals such as reduction in the corporate income tax, the pay as you earn, the upper threshold also to be pretty much as where the corporate income tax is, and also the value-added tax. This ideally should have been implemented in the current financial year if medium-term revenue strategy was adhered to. So we are hopeful that going forward, if they stick to the medium-term revenue strategy, it will reduce the uncertainty.
So Chacha, would you say then that looking at it regionally, especially here locally, that one of the reasons why they're doing this is because of the pressure, especially on public debt? And I really want you to center on Kenya, because I think that's still a conundrum. It's a concern, current economic pressures, including global interest rates hikes, all that, and government is really trying to balance. Would you say that's it?
I think to an extent that that was a factor, that they would want now to avoid getting into the financing, because if you look at it, the budget, you have a budget, but it has to be financed organically now through raising the taxes. And what is usually the case is that our expenditure far surpasses the tax revenue that you cannot be able to get. So you get into the financing bit. And how do you finance? You finance by borrowing domestically or even externally. So those are the sources of borrowing. And as it has been the case, more so up until late last year, borrowing even domestically was quite expensive. Right now we are seeing a breather in the sense that now the domestic rates are starting to come lower. Look at T-bills. Single digits it was 15%. Now you're getting into single digits, which is quite a welcome. At least they cannot be able to come domestic, borrowing domestic. Looking at external borrowing, you have either options of the concessional financing, which has conditions on one hand, and then you look at now the expensive, the commercial financing, the Eurobonds and the syndicated loans, which has no conditions, but their financing are quite expensive. So it's like the catch-22 situation, which way to go. But at least now, from a global perspective, the interest rates are starting to come lower. You've seen what has happened in the US. The rates, they have reduced the interest rates gradually from September last year up until December. The outlook is a bit quite blurry because there is a new president coming into office as from next week.
Yeah.
And then there's the whole tariff wars, which will have some inflation pressures, which will mean that even the interest rates reductions that we saw last year, probably not see them into the course of this year. So that's a bit of some uncertainty that we are seeing, but we may get some clarity as and when President Trump gets into the office. So, but at least there's a window of opportunity in the domestic rates now that the interest rates have been coming down, but obviously this debt servicing cost has been quite elevated and it's been eating a significant chunk of the spending pressures, and hence there's been some pressure to be able to raise the revenue so as to be able to address the spiraling up on the public debt.
Okay. Fred, let me bring you in, and I want us to dig deeper to some of these changes that really are affecting what Churchill is really talking about. And I wanted us to really talk, I want you to touch on how the multinationals are receiving this with that introduction of 15% minimum, but also combine it with the adjustments to pay and reliefs. I don't know, what is your sentiments on this?
Very well, Maina. So for the 15% minimum top-up tax, I think it is worth noting that it is not to be imposed on all the companies.
Okay.
I know we had minimum tax sometimes back, which was actually imposed in the Kenyan companies. If you ask me, actually, the minimum top-up tax is a good move, because what it is doing, it is giving Kenya the rights to tax. So basically what is happening is that there is a consensus within the OECD that multinationals should pay around 15% of tax. So what that means is that you need to compute the effective tax rate at the end of the year for the subsidiaries that are based here in Kenya. And if they have not hit the 15%, then they're supposed to top up the tax to 15%.
So what was happening all along? They were not paying?
They were paying, but what is happening is that because there's a bit of, they could be paying a higher percentage somewhere else, a lower percentage in that jurisdiction. So you just want to ensure that there's there's that level playing ground. So actually, South Africa, as we speak, has also introduced the same with effect from 1st of January. So most of the multinationals then are moving, most of the countries are moving towards that direction. It's actually going only to affect subsidiaries that are within a group that is making global turnover of more than 750 million euros. In the last 2 years of the 4 years immediately before the year that you are actually testing, which is almost 100 billion. So these are big multinationals. So I think it's a good move for Kenya. They moved with a bit of speed, like every other country is doing. Now, moving on to the pay-as-you-earn question and the question on reliefs and deductions. You'll recall, I think in the last 2-3 years, employees have faced the...
It's been tough.
And I'm sure probably you have felt it, because you have had something like increase in NSSF contributions, which is affecting your disposable income. We have had the introduction of affordable housing levy, 1.5% of your gross pay. You have had the introduction of the social health insurance fund, which is 2.75% of your gross pay. And all these are going into the same person. So I think under the Tax Laws Amendment Act, the government took a step back and said, can we now give back something to these employees that we have been taking away from? And that's why then we have seen quite a number of reviews there. We have seen the thresholds, some of them which have been around for more than 19 years. So if you look at things like pension, we are taking a deduction, the threshold was 240,000 Kenya shillings. It has now been increased to 360,000, and cash benefit from 36,000 shillings to 60, meal benefit from 14,000 shillings to 60,000. So quite a number of changes in there. And as far as thresholds are concerned, in my view, I think it's high time we think about inflationary adjustment, so that we don't have to wait for 19 years for us to adjust. We could maybe talk about every 3 years we probably inflationary adjust those particular thresholds, because remember, there's inflation in the economy.
Absolutely.
And as such, then you may need to review such thresholds. And of course, now that SHIV and affordable housing levy is deductible, it also gives back to the employee some amount in form of then which goes into the disposable income. But as far as affordable housing and SHIV are concerned, I still belong to the school of thought that there could be need for us to consider a cap for both of them. A cap in the sense that, and I think when affordable housing levy was introduced, there had been a cap that had been introduced before. But there were conversations on whether caps would speak to the question of equity. I belong to a different school of thought, in the sense that, unlike tax that you pay for maybe, making of the loads, construction of the loads,
Yes.
or other public amenities.
The levies.
So these levies are actually ring-fenced. Ring-fenced in the sense that they are not put in the consolidated fund, but rather they are used to achieve a certain objective.
Okay.
Talk of health, talk of the other one, affordable housing levy, on the affordable houses.
Okay.
So there are those who actually contributing, but they may never benefit from them.
Benefit from it. Yeah.
If you look at some of the guys who are earning a lot of income, they may not necessarily, go for the shiv. But so as a result, then you have someone who is contributing quite a lot,
Absolutely.
and in return they are not getting more.
They will never use it.
And that is why the same case applies to affordable housing. Morally, affordable housing, as the name spells it, it is expected to help those of us, in the lower cadre, in the sense that you're able to get that affordable housing. So then there is the question of, for those who probably are earning more and they are not necessarily directly benefiting from this, is there room to consider a cap? And I believe maybe sometime in future, maybe the government will think about it.
Thank you so much for that. My goodness, time is not on our side, but I want us to touch in summary as we come to a close. And I think, Churchill, thanks so much for really even touching on some of the questions I prepared on you on. And I just wanted to ask you just to touch briefly on the inflation and the cost of living. As Fred has mentioned, there was all these reliefs and everything else. But what we have seen is that the high cost of living still remains a pressing issue. Why I'm saying that is because we have been saying, inflation has gone down. But when we look at how Kenyans are feeling, they're not celebrating yet. Just from Christmas, most of them are not very happy. Why is this not happening? What's going on?
So there's a dichotomy between the official inflation numbers. As of December, it was 3%. And obviously, and how they arrive at that is basically a general basket of commodities, which now, if you look at on an individual basis, it's basically, it's out of touch, basically, that 3% on a year-on-year inflation between December 2024 against December 2023. So, case in point, if you look at that official basket, the largest component is basically mobile phone airtime, 5%. So it means that even for the people who are paying rent, it's like the rent is even less than the amount that they use in a mobile phone airtime, which is hardly the case. People, their largest component is either on food. Getting into this month, obviously there's parents with school fees. So obviously there's been a wait, and obviously there's been some increases in those segments which are not captured within the inflation. So there's that basically, there's the official inflation number vis-a-vis what people are feeling on the ground. So, and to the point that even Fred mentioned, over the years, the last financial years, you've seen even the disposable income has shrunk. We've seen all these deductions that have come, additional NSSF, now the pivot from NHIF to SHIF, and affordable housing. So if you compare 2 years ago and right now, obviously the disposable income is now much lower. And then you still have this costs that have to be met. So you find that is where the cost of living pressure is coming from, and that's the pain point to common mwananchi. Still having the same the same pay slip, but now on a net basis has shrunk vis-a-vis 2 years ago, and then the expenses are quite high. So that is where we are. So unless now there could be a clear purpose, or there could be a direction, even in terms of if there's value for money that is coming from all these contributions that people are making, at least it could alleviate the pains, but that is not the case. So probably they could submit some clear strategic communication as to how the pain pressure points might be sorted out, so that even people can say, okay, yes, there's these contributions, but at least it's I can see value for money. But as the case, that is not, as it is right now, that is not the case, which is quite unfortunate.
Okay. As we come to a close, Fred, I want to give you a power-packed question, which is first of all for you to mention on the electronic tax system compliance. I don't know what you feel in terms of compliance with ETIMS. And then number two as well, could you tell us something about the tax amnesty extension and what it really means for people as we come to a close?
Very good. Thanks, Maina. So e-teams is, of course, a very welcome move. And I think most of the jurisdictions across the world are actually moving towards what we call electronic invoices. To certainly then help net more taxpayers within the net. The only issue with Kenya, and I think I've mentioned it a few times, is the speed at which we are doing it. You know, it's almost like sprinting. Within a very short period of time, you're expected to comply and move on. But I think we have seen a lot of efforts by the government, including the Kenya Revenue Authority, to ensure that people are enabled. I think you might have seen reverse invoicing that has been introduced in Kenya, just to ensure that if you are a small-scale trader out there and you're not able to comply for one reason or the other, someone, the person buying from you could actually generate the invoice for you. That's what it calls reverse invoicing. So I think you're seeing a bit of effort on that one. So, and I hope it is successful. My only request maybe would be in terms of, and I think many people have spoken about this, in terms of maybe shelving or rather postponing the deductibility of expenses, because the law requires, effective 1st of January 2024, the law requires you to actually only take a deduction of expenses that are e-teams, are supported by e-teams related invoices. So given that there was a bit of lag in terms of people being able to comply, because e-teams is also, besides just being technologically enabled, is also a culture conversation. So you can't change the culture of people overnight. I think you might have seen people somewhere complaining that avocado farmers were being, there was tax that was being introduced on avocado farmers. It was actually a conversion on e-teams. I don't think it was anything to do with a new tax. So you got then to take a bit of time to change the mindset of the people. So I hope we can probably take it that way. Quickly moving on into tax amnesty, a good thing. It has now been extended to 30th of June of 2025, and the base period has also been reviewed to 31st of December of 2023, which then gives taxpayers the reprieve, or rather the opportunity to go and maybe rectify a few things. And I think one of the reasons why it was reintroduced, in my view, is because of some sort of ledger cleanups. There's something that the Revenue Authority is doing in terms of moving balances that are as old as yourself. I don't know how old you are. But some of those balances are being moved now into iTax. So it then gives taxpayers the opportunity. If, for example, you can be able to support that the principal tax was paid in good time, the taxpayers now can be able to, to just provide that information, and the Revenue Authority is able then try to have any penalties and interest that are there on. The only caution that we need to be a bit careful on is sometimes recurring tax amnesties may translate to recurring leniency. So you also don't want to have them very, very frequently. Like the case for ladri.
So the point is to take advantage of it, especially for a business, is it?
For sure.
And by the way, the Cabinet Secretary now has more powers on it, right?
Yeah, they do. The Cabinet Secretary has more powers, but that is even, now the more powers is even on the abandonment. It used to be there prior to the Finance Act of 2023. The only few changes that have happened is that now the Cabinet Secretary has been empowered to be able to abandon, but also some checks has been put in place. Like now they need to table the names of the people they have abandoned the tax for, the quantum and the reasons they have abandoned. They have to table that in Parliament for Parliament to approve or annul. The only thing is that even for annulment, it is like of no consequence. So there is maybe need to look at that law that we ensure that if there's annulment, there is a consequence for it.
Excellent. And transparency and fairness as well.
Exactly.
Churchill, I want to give you the pertinent shot so you can help us close this. I don't know what's your closing remark on this conversation.
As far as tax amnesty is concerned, let me just pick it up from there. Basically, they need also to, these extensions, but I mean, it's not a silver bullet. They need to go to the underlying issues that is bringing about businesses are not able to pay their taxes in good time for one reason or another. Is it that the business environment is not that conducive? So they need to go to get at the bottom of the issues so that they can ensure that there's more compliance rather than resorting to picking, say, 40 billion, 30 billion each and every year from tax amnesty. And now, rather than looking at why they're not doing the underlying businesses. So it speaks even to creating a more conducive environment for the businesses. Obviously, the private sector has been quite impacted negatively. If you look at it on my closing parts, it's quite a big driver in terms of the consumption activities. So if you look at the GDP, there are a number of factors that drive it. There's the consumption by, as you consume.
Yeah.
You go to the supermarket or you pay school fees. That's part of the consumption, private consumption.
Yeah.
There's the government spending. Now that ties into the fiscal. There's now the exports, net exports, and also the investments. So private sector consumption accounts for around 70% of the GDP. So it's a significant weight. But over and above that, data up until last year, September, it showed that even the credit to the private sector has sort of nosedived to around, it was quite flat at 0%. So it's showing that even the lending environment was quite prohibitive. But at least end of last year, we saw that the CBK has given an intent, or with that 0.75% reduction in the lending rate, which in a way could now get into the lending rate by banks. That was from the benchmark rate. So probably that could be one of the levers that could reignite consumption activities in the economy, but also the government has to play its part, at least to be able to ensure that there's some stability in terms of any of the policy guidance.
Okay. Thank you so much for that. Fred, you have the pattern shot. I know I cut off some of your questions, but I hope we will not have protests. But what is your pattern shot this time?
No, not protests. So maybe just a parting shot is in terms of, just before the dust settles, we have seen the Cabinet Secretary of National Treasury has invited comments from the stakeholders on the finance bill of 2025.
He's doing a lot of work.
It's a lot of work, actually. The only thing is that we do hope, and as Churchill did mention, and I think is a conversation across the country, is we may need to recheck the frequency at which we are doing the tax changes. So we can only hope that maybe what we'll see in the Finance Act of 2025 are more of policies that are targeted towards spurring economic growth in the country, and also promoting investment. And also, most importantly, changes that would speak also to what we have in the medium-term revenue strategy. So we did mention there are quite a number of good things there. Proposals to reduce some of the tax rates, including the VAT rate and the CIT rate, and also the pay-as-you-earn rate. So we hope that these are changes that we'll see. And of course, also the review of the pay tax bands, which are seen to be less progressive compared to most of the other jurisdictions. So we hope to see a better 2025.
So Churchill, I want to put you on the spot, and I want you to complete this sentence. For us to attain stability as a country, this is a sentence. If I were the president, I would.
If I were the president, I will focus on policies that could now be able to bring additional income to pockets of ordinary person. That could be my focus.
Excellent.
Thanks.
Fred, you're not left behind. If I were the president, I would.
If I was a president, I would probably focus my energy from mobilization of more tax revenue, especially with additional taxes, but focus more on policies that aim to spur growth, as I did say, in terms of production, but also most importantly, review our expenditure and ensure that I keep everyone in check to ensure that there is value for money.
Thank you so much, gentlemen, for your time. Much appreciated. Churchill, Fred, keep doing the Lord's work of really helping us understand what's happening in the country. There you have it. That's the trading bell. I leave you now with the markets.